Hi, everyone. Let me welcome Stephanie Singer. She is a lawyer extraordinaire at Morse. And today she's going to be talking about the legal terms associated with being inside of an incubator, financing rounds, etc. And if you are in the startup world or have been a founder or are a founder, you've considered whether you should be joining up at an incubator. It's not an uncommon thought to have when you're thinking about how do I get from ideation to launch. So what we're going to be looking at today is not just the kind of the process of getting in it, what it means for your startup, but also what it means for fundraising opportunities, how to look at some of the equity issues that are involved, and looking at some of the legal implications of being part of an incubator. So with that, let me introduce Stephanie. She is well known to our community. This is the third, I believe, Stephanie, session you've done with us. And we have another one coming up. I believe it's October 13th on Founders Do's and Don'ts, another not to be missed session. So a little bit about Stephanie. She provides legal and business advice to entrepreneurs, startups, and high growth companies throughout their life cycle. She represents a wide range of technology and life science companies on formation, equity related matters, corporate governance, venture capital financing, mergers and acquisitions, ongoing corporate matters, etc. In addition, she represents venture capital funds in making portfolio investments. She's also considerably experienced with public offerings, public company counseling, and fund formation. She also represents numerous nonprofits on a pro bono basis, assisting with incorporation, acquisition, tax-exempt status, and ongoing corporate counsel. She is on the board of directors of a local nonprofit called One Can Help. Stephanie graduated magna cum laude from Brown University and received her JD cum laude from Harvard Law School. She is a teaching assistant for the she was a teaching assistant for the Popular Negotiation Workshop and the editor-in-chief of the Harvard Negotiation Law Review. And she is also has been named a rising star by the Massachusetts Super Lawyers in 2018. So, wow. Stephanie, I can't thank you enough for being with us again. I know that this is going to be an incredibly valuable session for anyone who is thinking about being part of an incubator. So I pass it over to you now. Thanks so much.
Great. Thank you, Regina. Thanks for that nice introduction. And thanks to all of you for joining. I think some of you were at the last session or maybe the first one. So nice to see you again, or at least see your names. None of you have your video on, so can't quite see you, but that's all right. Give me 1 second here. I'm going to share my screen and then we will dive right in. All right, let me just put this on slideshow mode. All right, Regina, give me a thumbs up if you can see the screen.
I can see it.
All right, great, thank you. So as Regina mentioned, today we will cover incubators. We'll start with the very basics. What is an incubator? What are the pros and cons of doing an incubator, or accelerator as they're sometimes called? We'll talk about the typical terms that will be agreed upon between your company and the incubator. And then we'll talk about how those terms affect your ability to raise financing in the future. So what is an incubator? Sometimes you'll hear accelerators. I'm going to use them pretty interchangeably for this presentation. An incubator supports new ventures during the idea stage. They provide resources. Often they'll provide money, funding, sometimes upfront funding, sometimes an investment for future rounds, for you to get your idea off the ground. They'll often provide physical space. That's obviously changing right now due to COVID, but in general, there's a physical space. You'll have office space, access to conference rooms, etc. The incubator will provide access to advisors for various parts of your business. So marketing advisors, sales advisors, growth advisors, legal advisors. And it will provide mentorship and general business advice. Some more than others may have a full curriculum of classes, like a mini business school boot camp that you go through, learning all types of, discussing all types of topics around starting a business. They'll also provide networking with other entrepreneurs. So most incubators will accept a number of companies for each class or cohort or season. So you'll be able to network with those other entrepreneurs, share ideas and tips and tricks. And then incubators often will give a stamp of credibility to a company, especially if you're in a well-known incubator. You'll see all the time companies when they go out to do a financing round, they'll be marketing themselves by saying, you know, we were Techstars class of 2018 or Y Combinator class of 2020. So they can give some much needed credibility to your business, especially for first-time founders who don't otherwise have that reputation in the startup community. Drawbacks of an incubator. So there are an increasing number of incubators, which means that they are now of mixed quality. There are so many that it's not as difficult to get into one as it used to be. So you don't get that same boost in credibility just from having gone through an incubator program. You should think about how the incubator looks to potential VC investors. Some are more well-known than others. Some give you that stamp of credibility, others less so. You know, for some companies, you worry that going through the incubator makes it look like they couldn't do it on their own. They couldn't get their own access to advisors or access to capital and needed the help of the incubator, which could have a negative effect, as opposed to, you know, you may think you get in an incubator and that's sort of your first saying to VC, hey, this incubator accepted us and therefore you should as well. The terms that you'll enter into with the incubator are not always company favorable or founder favorable. They might cause, we'll get into this more, but they could cause significant dilution to founders or put other restrictions on the company's ability to operate. And at times, the program requirements could prove a distraction from running the business. So for those incubators that have this boot camp business school curriculum, you're going to be in meetings and in lessons and in classes a lot, which takes time away from the time that you could otherwise be spending growing your business. So what should you look for in an incubator? Well, you want to make sure it's a good fit with your company. You want to make sure that the incubator has industry expertise in the area that you're interested in. So there are a number of industry-specific incubators. There are some that are just for biotech companies or just for robotics companies. And the more specific they are, the more tailored advice they will be able to provide to your company. You want to look at the network. So how many classes have they had that have gone through? Are you being connected to those former classes? Who are the mentors or advisors that they have on staff or that they have connections with? Are those people that are going to be able to add to your network, to provide a boost to your company, to make connections that you need to move forward? And again, less so in the COVID world, but location. Many of these incubators do require that you reside on site during the term of the incubator program. So do you want to be moving to San Francisco or Boston or, you know, wherever else the incubator may be located? You'll want to look at the quality of learning and the quality of mentorship. Make sure that it's high quality and that it is giving you something you couldn't find just by, you know, researching these topics yourself on the internet or by talking to other founders who you may know personally. And you also want to see if the incubator will provide access to investment. So the incubators themselves will typically invest in the company, but it's also helpful to have an incubator that has relationships with VCs, angel investors, and other investors, so they can make those connections for you and help you get to your next round of funding. So let's look with a little bit more detail on incubator equity. So incubators take equity in one or both of these two forms. The first is upfront equity, meaning that when you join the incubator, when you start the program, you will give them equity in your company. You will give them a percentage ownership in your company. You'd want to think carefully about the amount of the equity that you're giving them and about what type it is. So in terms of amount, typical incubator terms are, I would say, between 4 and 10% of your company, just for the privilege of being able to participate in the incubator, which is a decent chunk of equity. It is, you know, if you have a few different founders, you know, it's obviously a smaller percentage than that held by any of the main founders, but a not insignificant amount. If it is a percentage, which is fairly common, you know, the incubator will say, we will take 5% of your company, or we'll take 6% of your company. You need to think about how that is calculated. Is it just based on the founder stock? Or if you have set up an equity incentive plan, an option pool, in order to grant equity to employees, is that taken into account when figuring out the percentage? Is that negotiable? Can you play games with the size of your option pool to get the incubator equity down? Or, you know, is there something on the back end that would prevent that? You also want to look at what type it is. So are you giving them stock up front? Or some incubators will take a warrant, which is the right to purchase stock in the future at a preset price. The other type of incubator equity is incubators will often make an investment in your company in return for future equity. This is often structured as a convertible note or as a SAFE. And for those of you who are at my first presentation, I guess 4 weeks ago now, we went into a lot of detail on notes and SAFEs and what are the terms and what should you look for. And all of that applies here to the note or SAFE being held by the incubator. The most important term for these purposes is figuring out what is the valuation that the SAFE is putting on your company. So if they say, you know, they'll invest $150,000 into your company at a $3 million pre-money valuation or post-money valuation or $4 million valuation, those are the terms that you will be negotiating to figure out what percentage of the company this SAFE or this note will represent when it converts. So spending a moment on the effect on valuation. So when a company is granting options to employees or consultants or other service providers, which is a very typical way of compensating startup employees. Typically, startups don't have a lot of cash. They can't be heavy on the cash compensation, but they will give an ownership interest in the company to employees. And that option has a price that is based on the current value of the company. So one of the pieces of, one of the complications with incubator equity that people often don't focus on at the early stages is, let's say an incubator, I'll take Techstars for example, they make their terms publicly available. If they're investing, they're giving you, say, $20,000 for 6% of the company. That, in effect, places a value on the company, right? If 6% of the company is worth $20,000, you can do the algebra and figure out how much the company is worth. And that is now going to be a relevant metric when you're granting options to employees. It's going to be pretty hard for you to justify to the IRS why you're granting options at a price that's less than the price that Techstars paid, which is probably a lot higher than you would have been granting options at otherwise. So just one sort of side note to keep in mind when there is upfront equity. The other way that the incubator terms can have an effect on the company's valuation is via the cap in a note or SAFE. So typically, the cap will be a proxy for what your company's valuation is at the time that you enter into the agreement with the incubator. So you'll want to think about what that is and how that might propagate through future rounds. The cap in the note or the SAFE doesn't have the same effect on the option grants, as really that only comes into play when you're granting actual stock today, or selling stock today, I should say, to the incubator. Less of an issue with notes or SAFEs, but still something to be aware of. One of the key terms that you'll find in these incubator agreements is what's called anti-dilution protection. And what that means is that if the company issues additional stock in the future that would dilute the incubator's ownership, the company has to issue more shares to the incubator for free. So the deal with the incubator is, let's say they want 6% of the company. The deal is that they get to keep 6% of the company. And if you bring on a new co-founder or you hire employees, and you make a grant to them, then if that brings the incubator's equity down below that 6%, you'll need to give them more equity to bring them back up to the 6%. That 6% is a guaranteed amount. So some things that you should think about when negotiating this anti-dilution term with the incubator is, what percentage is their anti-dilution protection at? Is it the same as what they get up front? Is it they get 6% up front and they get to keep 6% all the way through? Or is it something lower? You give them 6% up front, and if it drops below 5%, you have to give them more stock, for example. Typically, they get to keep their same initial percentage. Think about what type of stock you're issuing them if there's dilution. Are you giving them more common stock, or are you agreeing to give them preferred stock when you do have preferred stock? Are there any exclusions? So sometimes you can say, you know, if we have an option pool set aside for employees and we're making grants out of that pool, each time we grant new stock or new options to an employee, we don't need to re-up the incubator. We sort of take that all into account with the whole pool at the beginning. Or maybe if you take on venture debt, you know, you go to a Silicon Valley bank or something like that, take on venture debt, and they require that you issue them some equity in connection with that. Should that trigger the incubator's anti-dilution or not? So there will be a negotiation over what types of issuances count as diluting them and trigger this anti-dilution protection. A key question is when this anti-dilution protection should terminate. So they're not going to have this forever and ever, right? You're not going to be 10 years in the future and they're still going to have their 6% of the company. Typically, the protection terminates when you do your first serious financing round. But there's definitely negotiation over what that means, right? What is a serious financing round? Is there some minimum threshold, like when you raise $1 million worth or you raise $5 million worth? Typically, it has to be a preferred stock round. So if you're selling notes, if you're selling safes, that won't do it. It will have to be an equity round where you can actually calculate everybody's percentage ownership. If it is at a qualified financing at a minimum size, let's say they have anti-dilution protection through the time when you raise $1 million. But let's say your financing round is $2 million. Do they get to be at 6% after the whole round? Or do you figure out, if you only raised $1 million, what would 6% be? And that's what they get. But then by the time you sell the additional $1 million, they're going to be diluted a little bit below the 6%. So this can get really tricky. And you need to be looking at your cap table in Excel and figuring out how much equity these incubators will have at the end of the day based on the type and size of equity financing that you expect to do. The anti-dilution shares that you need to issue to the incubator will typically count in the pre-money when you do a financing round. So again, going back to my slides from a few sessions ago, when you do a financing round, the investor will put a value on your company. Say your company is worth $10 million, and they figure out their price per share by saying $10 million divided by the number of shares outstanding is the purchase price. So all of these incubator anti-dilution shares will go into that denominator, which will reduce the purchase price, which will cause more dilution to the founders and other common holders. So any of these terms, the upfront equity, the anti-dilution, all of that will end up eating into the percentage that the founders retain of the company. So the discussion that I was just having about this anti-dilution protection applies primarily to upfront equity when you give the incubator equity, common stock upfront. Some incubators don't take common stock upfront, and instead they just do a safe, or maybe they do both. But if they're giving you a safe, they're investing some amount of money, say $100,000, in a safe that has a fixed post-money valuation. That's really the same thing as anti-dilution, because you know you can figure out upfront what the safe will convert into when it converts, right? If it's $100,000 and your company is worth $1 million, it's going to convert into 10% of the company. And they're going to be guaranteed that 10% no matter what else you do between now and conversion. So by doing a post-money safe, you're in effect giving the incubator the same type of anti-dilution protection as you would if they just had common stock up front with this more formal, more complicated anti-dilution protection. which, by the way, is one of the reasons that safes came into vogue, particularly with accelerators like Y Combinator. One other piece while we're still on valuation and equity. So not universally, but in many incubators, you will see this term that says that the company has to pay what's in effect a fee to participate in the incubator. Sometimes it will say a participation fee, sometimes it will say a marketing fee, but really what it comes down to is the company paying the incubator to be able to be in the incubator. And they will put in some language about how they're being so nice and you don't have to pay them now when you don't have cash. Instead, they'll just take it out of their investment, or they'll take it out of the investment when you do raise a financing round. So let's say you're in one of these incubators where they're going to make $150,000 investment into you in the form of a safe. But you need to pay them $50,000 in participation fees. So really, they're getting $150,000 safe, but they're only giving you $100,000, which is a 33% bump on their investment right away. So while it's called a program fee, what it really is a hidden adjustment to the company's valuation, right? It's giving them free shares. It's giving them $150,000 worth of shares for $100,000. So definitely something to be aware of when you see any sort of fee involved with an incubator or accelerator. So let's turn to some other rights that typically are granted to incubators in connection with participation in a program. The most common one is participation rights, or you'll sometimes hear this called pro rata rights or preemptive rights. This is the right to invest in future financing rounds, typically in the qualified financing, the one that triggers the antidilution and that triggers conversion of the safe or note, and potentially in other rounds going forward. The elements to negotiate here is what level of participation do they get? Do they get to invest a fixed amount of money in your next round? I've seen incubators that say, we get to invest up to $200,000 in your next round. Or perhaps it's a fixed percentage, which is typically based on the percentage that they hold prior to the round. So let's say the incubator has 6% of the company prior to the round. You'll often see what are called pro rata rights, where they will get to buy 6% of the new round, in order to maintain their percentage ownership in the company. You'll sometimes see what's called a super pro rata, which means they can invest more of the round than their percentage ownership in the company, and they can, as a result, increase their ownership percentage. So maybe they only hold 6% of the company, but they negotiate for the right to buy 20% of the round. Or sometimes you see a combination. One incubator that I've worked with says, we have the right to buy the greater of $200,000 worth or 20% of your next round. Very, very important to think about when this right terminates. Is it just the right to invest in your first round, or do they have a right to participate in every round going forward? This is one key area that could impact your ability to get VC financing, because in a typical VC financing, the investors will get these same participation rights, pro rata rights, but usually you need to invest, an investor needs to invest a minimum amount to get these rights. So maybe you'll have 2 big investors and 10 little investors, and only the 2 big investors get these rights. So the big investors don't want to see a lot of little guys with these rights. So when you have an incubator that also has rights, it can complicate your ability. You know, the VC may insist that only they have these rights and that the incubator terminate, and then that gives the incubator negotiating power because you're asking them to do something in order for you to be able to raise your next round. It also can get really complicated just from a logistics and mathematical perspective if the incubator has participation rights via the incubator agreement, and then separately you have other investors with participation rights in a different document, and maybe they calculate the size of the round a little differently, or they calculate the denominator of how you figure out how much they get to invest differently. And it can get really complicated. It's much better to have all of these rights in one document. So you want to think about maybe the incubator's rights terminate when they become party to the main investor agreement, the investor rights agreement, that gives them similar rights. What you don't want to have is these rights existing on a separate document into perpetuity with no way to terminate them without the incubator's consent. Just like with the antidilution, you want to think about what are the exclusions. So when it says they get to invest in future rounds, what does that mean? What counts as a future round? What if you're just selling notes? What if you're just selling safes? What if you're just issuing equity to employees? What if you're issuing equity to Silicon Valley Bank in connection with a debt deal? Do they get to participate in any of that? Or is it just a full-on VC style preferred stock financing? And yeah, again, think of the effect that all of this will have on your future rounds. Another right that incubators typically get is information rights. So this typically refers to financials. They may require that you give them annual, quarterly, or even monthly financials. Many incubators require specific reports on things that are important to them, on key performance indicators or other business level objectives that they want to see you achieving. They may get inspection rights, which is the right to come visit your offices, talk to your employees, check out your premises, get access to other information that you may have on hand. So you want to think carefully about what information rights you're giving them, and are you comfortable with them having all of this information? What are they going to do with it? One thing to look out for is when an incubator wants blocking or approval rights. This is atypical for incubators and really should make you think twice if you have an incubator looking for things like this. But you may see an incubator put some language in that says you can't sell the company without their approval, or you can't sell the company for a price less than X without their approval, or you can't sell the company's assets or exclusively license the company's assets, or you can't do a new financing round without their approval. All of this is really problematic because it gives them a lot of control over your business. You want them to be able to give you a boost to help you get to the next stage. You don't want them to be able to stop you from getting the next stage. And this is particularly problematic if they hold a note, because a note is debt. And if they have a note outstanding, let's say for $100,000, and you don't have any cash on hand to pay it back, you need to raise a new financing round in which hopefully the note would convert. If they can block you from raising a new financing round, then you can't pay back their note. Then they can put you into bankruptcy and they can take all your assets. So you really want to avoid a situation where any note holder has the ability to block you from raising enough money and then call their note and put you into bankruptcy. So be very careful of any sort of blocking or approval rights. Other rights that you sometimes see, an observer right or board observer right. This is the right to have a representative attend meetings of your board of directors and receive materials that are distributed to the board. I've occasionally seen a put right, which is a right to force the company to buy back all of the incubator shares at some fixed price. This is atypical. It will happen if the incubator is worried about typically negative publicity. If there's some sort of problem with the company and the incubator wants to wash their hands of them, they want to be able to say, look, you no longer fit with our values, or, for whatever, maybe there's a regulatory reason. For some reason, we don't want to be involved in this company anymore, and you have to buy back all of our stock for some fixed amount. You also sometimes see an MFN, which stands for Most Favored Nations, which is an agreement that says if the company issues securities to anybody else with better terms, then the incubator can take advantage of the better terms. So let's say the incubator has a safe with a 20% discount on conversion, and you do another safe for a different investor where you give them a 25% discount, which is better than a 20% discount. This MFN would mean that the incubator would then get that 25% discount as well. That's also less typical, but you do see it sometimes. So these are all terms that are, more incubator favorable. What are the company favorable terms? What are the deal terms that you want to make sure are in your agreement with an incubator? You want reps and warranties, so you want the incubator to make statements about themselves in order to make sure that you're complying with securities laws. So things like, we are sophisticated, we can afford to lose all of the money that we're investing in you, we know what we're getting ourselves into. You want to make, we won't transfer these shares on the public markets. You want the incubator to make all of those representations to protect you from a securities law compliance perspective. You want a lockup, so if and when the company does an IPO, they can't sell their shares for the first 6 months. And that's something that any underwriter in an IPO will insist on. Better to get it now than to give them negotiating power when you're about to go public. You may want restrictions on transfer, so they can't sell their shares to a third party without getting your permission or without giving you as the company the right to buy the shares first. That's sometimes called a ROFR, right of first refusal, where the incubator has to give the company a right of first refusal on any transfers. Ideally, you would make sure that any rights that they're getting in the incubator agreement are superseded by any similar rights in the main financing documents. So this is what I was referring to earlier, that it would be very complicated to have duplicative rights in multiple documents. You'd rather just make them party to one set of documents with all your other investors and have everybody on the same terms. And you'd like them to sign a confidentiality agreement. So if you're giving them the information rights referred to a couple slides back, you definitely want them to agree to keep all of that financial and other business information confidential. But also you're going to be, just by virtue of participating in the program, you know, you're going to leave papers out on your desk, or you're going to be talking to, you know, some of the mentors or incubator staff about your business. And you want to make sure that they're obligated to keep that confidential. So that's it for the slides, but I would be happy to take any questions from the audience.
Well, that was really great, Stephanie. Thank you so much. I want to ask a kind of a starter question. How flexible or how much wiggle room does one have to negotiate these terms?
Good question. It depends on the incubator. I would say that the sort of more well-known, higher quality, top-notch incubators have a fixed deal, and it's a take it or leave it situation. But even in those circumstances, if you're represented by a lawyer and you're having your lawyer negotiate the agreement with the incubator, there's some room for, I would say, making improvements on the incubator agreements. Often the way that the pro rata rights are written is very confusing or complicated. So there's some room for improving it, but the deal itself, you know, the 6% for $20,000 or whatever the deal is often fixed. In some other newer incubators that are getting started, or if it's a really hot company, or for whatever other reason you have more leverage, there might be a little bit more wiggle room.
Right.
But incubators are rightfully wary of having a lot of leeway, because it's just very complicated for them to track, and it's much easier for them to say, this is our deal, we have the same deal with everyone, and they don't want to be making one-off exceptions.
That's great. I mean, especially given the times now, I suspect those of us thinking about going into incubators are thinking we can cut a better deal than ever before. So a certain bit of reality, a dose of reality is very helpful. Is equity, another question that is, coming up in the pre-submitted series, is equity or political control of the board the bigger issue? Like if you had
so typically an incubator is not going to be having a board seat at all, let alone control of the board. They will be taking some equity, but it's not going to be any sizable chunk enough that they will have any sort of control even as a stockholder. So they're really a minority stockholder. They're going to be along for the ride. The purpose of the preemptive rights, pro rata rights, is to be able to maintain their percentage ownership going forward, but it's going to be a single-digit percentage ownership. It's not going to be anything where they're really running the show by any means. It's almost, many incubators view it like founder equity. It's sort of the, get you off the ground kind of equity, as opposed to any sort of control stake.
So to everyone, please put your questions in the chat box, or if you'd like to be on camera, turn your video on and I guess raise your hand or let me know some way. So Stefan is asking this question. Do you have any suggestions on how to approach, negotiate, avoid blocking and approval rights to best protect our startups from the unfortunate potential situation you described? Wow.
Yeah, great question. I think the best way to position it is that it's you and the incubator are in this together, in that you both want the company to raise its next round of financing and you both want the company to succeed. They're not going to have any value, either, you know, monetary value in their equity or the ability to brag about you, right, if the company is not doing well. So I think by saying these terms will hurt my ability to grow, will hurt my ability to raise future financing, you know, we all want that to happen. Let's not put any roadblocks in our way. And then they'll typically come back and say, oh, no, we never would block it. We wouldn't do that. And then, you know, you, of course, come back with, then why do you need it, right? Like it's the flip side of the same coin. If they would, because they'll say, oh, we'll never do it. Don't worry about it. But then you can say, well, if you'll never do it, what do you need it for? And if you'll really never do it, then, you know, stand up behind that and take it out of the documents. And I would say for an incubator, it's pretty rare. You're definitely going to have that same argument with every investor, right? But the incubators aren't usually looking to be an impediment to the company's growth.
Right. This is a really interesting question that I think many people have been curious about. Do incubators typically seek fees if they help raise additional funds for you?
No, they don't typically. And the reason for that is broker-dealer rules. So the SEC has rules that say if anybody is going to get paid for connecting a company with investors and they're going to get paid, say, a percentage of what they help the company raise, they need to be registered with the SEC as a broker-dealer. And incubators don't want to bother with that hassle, and it is a lot of hassle. And at the same time, they're smart enough to know that that rule exists and that they shouldn't be doing it without being registered. Right. If you see somebody, by the way, and this is aside from incubators, if you ever have somebody who says to you, hey, I'll help you raise money and I'll just take, you know, a small percent, 1%, 2% of what you raise, you better make sure that they are a registered broker-dealer, registered with the SEC. There are so many unregistered broker-dealers out there, and it can get the company into a lot of trouble. Not right away, because the SEC is not going to find out about you, frankly, but, you know, when you're trying to go public or when you're doing a financing round and you have a sophisticated investor doing diligence, or you're trying to get bought and you have a sophisticated buyer doing diligence, it's really going to come back to bite you. So no unregistered broker-dealers.
Wow. And I'm sure there are a few out there, huh?
Many.
Many, yeah. Thank you, June, for that question. Brian has, you know, a question that I know many of us have thought about as well. You know, there's so many incubators and accelerators out there. And I suspect you can categorize them for the best to the not so great. What have you seen the incubators and accelerators offer in terms of services, connections that were the best? I mean, what set them apart from all the others?
Quality of the network is huge, because that's something that you're going to call on time and time again throughout your company's life cycle, not just your initial funding round, but, you know, when you're looking to hire your first, you know, head salesperson or chief marketing officer or chief financial officer. So having a solid network, both of companies that have gone through the incubator before and have been in your shoes and can give that sort of on the ground guidance, and the more of a, you know, mentor advisor type role, they can connect you with those. That's huge.
Right.
Obviously, the ability to connect you with high quality investors who can take your company to the next level, you know, do your first serious financing round. That's huge, right? Every company needs money to get off the ground and to grow. Yeah, I mean, I think those are really the two key ones. It's the business side network and also the fundraising side.
And how much does the success rate play into this?
What do you mean by that?
Well, you know, you go in as a You go into incubator to move along the startup journey, and then some make it to market, some get launched. Does that really matter when choosing the pedigree of an incubator?
So I think it matters to some degree, and it's worth learning about the incubator statistics.
Yeah.
I don't think it's determinative, because I think while the incubator is giving a boost to companies,
Mm-hmm.
but if a company doesn't make it, I wouldn't blame the incubator. I think there's a lot of factors that could cause a company to stumble, and I don't know that the incubator alone could have saved them. Do you want incubators that are accepting higher quality companies, because it'll probably be a bigger, mark of that, that you're in a good incubator and you got in and you're a company that's going to do well? Sure.
Right.
But, and if, the incubator's never had a successful company, I really wonder why. But I wouldn't think of that as much. I don't think I don't know that the incubator is going to make the difference between success and failure for a company.
Because when you see some of the marketing for these places, they talk about their portfolio of companies that have been successful. So just always wondering how it impacts. So.
Yeah, I think that's more of a marketing thing for them. And then for you, right? Like you can say, oh, we're in XYZ incubator that has a strong market presence. It's helpful. But, if as an entrepreneur, I would be more concerned with the experience that I get in the incubator and the connections that I come out of it with, rather than just, how good it looks on their website.
Yeah. So Thomas Mahoney has a great question. What has been your experience with VCs who also incubate? The advantages, this is great, the advantages, disadvantages to entrepreneurs. Right?
That's a great question. I've seen this a lot more in the biotech world than in the tech world, where you have VCs that are really helping a company get off the ground. I've seen it with some of these VCs where you don't even start with a founder. You start with some idea in a lab, and they hire a management team to bring it to fruition. I think that it can be really helpful in that you're getting serious money from a serious investor up front, and you have people who have been there before and done this, a million times before. Especially if they have good relationships with other VCs, they've co-invested with other VCs and other companies. I think it can be really helpful. Mm-hmm. It does lock you in a little bit, right? If you are participating in an incubator run by a VC, they're probably going to be leading your first round, and maybe the terms aren't going to be as good as they could have been if you had shopped around. But on the other hand, maybe you couldn't have, made the initial introduction to any VC, and this gets you there. So definitely pros and cons, in the sort of capture effect where they have you locked in. But if it's a reputable VC that you would want to be leading your first round and you can get in at an incubator stage, I think that can be very helpful.
Wow, great. Stefan is back with another great question. At what point does a successful startup disconnect from the incubator? Great question.
Good question. Yeah, so that's typically set up front. Typically, the incubator will have, they'll call them like a class or a cohort, where you are in the incubator for a specified period of time. You'll see people say, oh, I was Y Combinator class of spring 2016. So it is negotiated up front. There are some where you can, just stay longer, like use the office space and pay them some sort of fee for that. But in terms of the initial incubator program, that should be fixed up front.
Great. What is that average time? I know it's all over the place, but
yeah, it really varies. I would say like 4 months plus or minus, but it really is different depending on the incubator that you're in.
Does it matter in terms of the vertical?
Yeah, oh, absolutely.
Okay. And so Bert has a question. Can a non-broker dealer help get convertible debt, or is that still regulated by the SEC? Good question.
So convertible debt would be the same as equity for SEC purposes. It's still considered a security. You can have a non-registered broker dealer. You can have somebody who helps you make connections. You can have someone help you with your fundraising for sure. where it becomes problematic is when they're getting paid based on the amount that they're raising. And it's a little bit more complex than that, but if I had to give you the, nutshell answer on broker-dealer regulation, it's the getting paid the success fee is a problem.
But they could be paid a fee, just not a success fee.
Yeah, that's sort of getting a little complicated,
Okay.
but for purposes of Laura's question, notes, safes, stock, all treated the same.
So I have a very long question here from Patricia, and it kind of winds through a couple of topics that you've addressed in earlier sessions. Okay, I don't know how to dissect this exactly yet, but what tax filings need to be filed ASAP, resource for researching equity grants for different positions at the very early stage, etc. Could you please address what terms employees should be aware of for early employee equity, getting the units, LLC, or shares corporate in the hands ASAP?
So I'm actually going to be covering that in my next session. Let me put in a plug for the one in 2 weeks on founder do's and don'ts,
Yep.
on, founder equity, tax filings, early employee equity. So let me focus on the incubator terms for now, but I will definitely make sure that I cover that in my presentation in 2 weeks.
Okay, Patricia, it's October 13th, 4 o'clock. Founder do's and don'ts, sign up. Okay, so what's the biggest mistake you have seen founders make in moving towards being part of an incubator?
Just signing the documents that the incubator puts in front of them without reading them, without hiring a lawyer to negotiate them, without understanding what they are.
Simple as that.
I've definitely seen that. I've had companies come to me as they're finishing their incubator period, and I look at this and say, well, what did you sign up for? They own you, body and soul. So
Right.
Definitely. And again, I'm definitely a little biased here, but I would highly recommend having a lawyer look at the terms. Even if you're not going to be able to negotiate them, I at least want you to understand what you're getting yourself into, right? Like, what does it matter if you have a $3 million cap or a $4 million cap on your safe? Or what does it matter what the exclusions to participation rights are?
Right.
How is the incubator going to be tied up with you moving forward, and how can you free yourself of them, and where is that going to come back to bite you? And maybe you decide to go ahead with the incubator anyway, and that's absolutely your business call, but I want you to be informed about what you're getting yourselves into.
So, one of the things we wrote about in terms of describing the session is that red flag that comes up. Because dealing with this checklist of things to go through could really create some fog through the process, right? What are those red flags that almost break through the fog of all these legal engagements that you're looking into that we should be aware of?
So I don't know that there's any one term that by itself is a huge red flag. What I've seen, so I had a client a few months back that was doing an incubator, that was a new incubator that I had not heard of before, where every single place the incubator could sort of grab a little extra, they did. So they had pro rata rights and super pro rata rights, and they had a marketing fee that the company had to pay that came out of their safe, and a program fee and rent. And instead of a 20% discount on conversion on their safe, which is market standard, it was a 25% discount. And. There was just so much that it felt really exploitative. And it felt like they were just putting all this in there because they knew they can get away with it, because most founders have no idea what these terms mean, because the founders are rightfully focused on their business and running their business and their model, and they don't know all of this legal stuff. So that's where I really had to call them and say, are you absolutely sure you want to go ahead with this incubator? Because even if you're okay with these terms, it feels, frankly, a little sleazy to me.
Right.
And is this who you want to get into business with? Ultimately, they did the incubator and they found it extremely helpful. So it was worth it to them that this company in particular had 3D printer and lab space and all kinds of resources that they needed. But it's really, I don't know that I can point to any one red flag. It's just sort of a combination of these insidious terms.
Yeah, what I like about what you just said is that it's not just that checkoff list, but is it a good fit between who you are and your startup and your team's culture and the organization you're about to be married to for an important part of your journey. If it's not a good fit in terms of values or culture or expectations, all the legal checkoff points really don't amount to as much as it should. So I think
Absolutely.
that's really great advice. We're running down. I just want to ask one more question. Thomas has circled back here. And also, Patricia is definitely signing up for the next session.
Great.
She is appreciative of your wisdom. So back to Thomas. What stage is it reasonable for the next round investors to expect that your incubator will not re-up, which could be important if the incubator is a high prestige firm like Y Combinator?
Great question. So I think it's expected that the incubator will participate in the first round. Anything after that, I think, is fair game. I think typically you'll end up with a conversation among your lead investors, your incubator, any other big investors that you currently have, as well as the lead investors for the new round, and have a conversation about allocations. And if you have a lot of investors that want to get in, or one or two big investors that want to take up most of the round, there may not be enough room for your incubator to get in, and that may be okay, and it doesn't look bad at all. On the other hand, if you're doing one of these, like what I call a onesie twosie round, you get 25K here and 100K there and 50K there, and the incubator is not participating when the company clearly needs the money to get to the fundraise size that it needs to hit some sort of inflection point, then it looks a little more problematic.
Right.
So I think it's less about what number round it is and more about what the syndicate looks like generally, and is that a good sign of your company's ability to fundraise.
Right. I'm squeezing in one last question. It really is going to be the last question. It's from Joe Webby. Is a $2 million post-money valuation cap for a $200,000 safe acceptable?
So that's the safe is going to convert into 10% of the company when it converts immediately prior to doing your financing round. So I don't know. You tell me. Is that acceptable to you, right? Do you think that the incubator is so valuable to you that it's worth giving them 10% of your company? That's high. I think I would say probably, median around 6%.
Right.
So it's definitely on the high side. But if you think that they are providing a lot of value and they're getting you to a place that you wouldn't be able to get to otherwise, then maybe it is worth it. Anything like that about valuation is really comes down to a business question and whether you think they're worth it.
Right. Right. Again, it's that qualitative checklist that you have to think about. So I'm going to thank you, Stephanie. Really great wisdom, great insight, great legal knowledge. Thank you so much. And I'm going to plug her next session, which is Founders Do's and Don'ts. It is going to build on the earlier sessions that we've had with her. So do sign up. It's October 13th, 4 o'clock. Everyone is thanking you for a great session. Yes, it was a great session. So Stephanie, thank you again. We'll see you soon in October. Until then, be well.
Okay, great. And let me just say one last thing. If anybody, Regina, I'll send you a copy of the slides. I'm happy to have you send them if anyone's interested.
Yep.
And if folks have other questions, my email address is in the slides. You can feel free to reach out.
Yep. Excellent seminar.
All right. Thanks so much, everyone, for coming.